Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for WealthPress. Today's Friday. It's January 20th. It's about 8:15 in the morning. The market's going to gear up to open in about an hour and 15 minutes. Wanted to kind of show you what's going on before the opening bell. The NASDAQ is bouncing really well. The Dow Jones is barely, this is 29 points. Anything below 80 or up or down, 80 up or down is just random on the Dow. It's only up 28. And the S&P's meeting us in between. You might or might have not noticed that over the past few sessions, the Dow has been a lot weaker than the rest of the market. One of the reasons that's the case, and I've explained this several times, but I want to make a point of this, is, and I'll explain to you why. If you look at the chart, this is the Dow Jones. Let me just change the chart. Here we go. This brown line here, this ugly mustard-colored line, that's the 200-day moving average. Notice most of the trading actions happening above the 200-day moving average, right? Look at that. Ever since November, beginning of November. So for about 2 months now. Now it's coming down, but nonetheless, notice we're above the 200-day moving average. Look at the SPY. Look where the majority of trading actions happening. That's the 200-day line. Notice below, and headed down. And if you look at the QQQ, it's even worse. So the Dow should not, and I repeat that, see how everything is way below the 200-day? And on the SPY, it's a little bit below the 200-day. And on the Dow, nobody's talking about this, by the way. You're not going to see anybody on CNBC talking about this. Notice the Dow is still above the 200-day moving average. Well, I read in Barron's about a month ago, there was a little headline that said the difference between the Dow and the S&P in terms of relative performance is the biggest in 100 years, almost 100 years, since 1930, okay? So that's huge. That's what, 92 years or 93 years? Long enough. The point is, most of this trading action, remember, the Dow only has 30 stocks. So if 5 of the Dow stocks get overvalued in the short term, the Dow's going to look like it's a lot stronger than it is. And we've already seen 2 fake breakouts, one and another one right here, which I did warn you about. But I believe the Dow is going to be a lot weaker in the near term than the rest of the sectors because it's overbought in comparison. As you could see, it's trading well above the 200-day, which is why I believe in the next couple of months, you're going to see more weakness in relationship to other sectors in the Dow than you'll see in the NASDAQ or the QQQ. And remember, it doesn't take a lot. There's only 30 stocks in here. So if 3 or 4 stocks lose a little more value, it'll come back down. Nonetheless, regardless of which index you're looking at, the Dow looks like it's hitting the 200-day moving average. The S&P, which is already below the 200-day moving average, looks like it's getting ready to hit its old support level. And the QQQ, which is actually up today and actually been doing pretty well, still is battling staying above, but it has already lost the most value. Look how much it is below the 200-day. So we may, one, see less downside in the QQQ and the S&P, or alternatively, more downside in the Dow Jones compared to the NASDAQ and the S&P. I hope you guys understand that. That's very significant, something you should be paying attention to. Number 2, the bond market. Notice the bond market. Oh, man, I really wanted to sell the bond market, but I wanted to wait for it to get to the 110 level right here, like it almost did right here. We were too early the time before, but we did make profit. We've been 5 for 5 on bonds. I have a personal challenge. I want to be 10 for 10 on bonds. So I want to see if it gets up to the 110 area. I have a alert there to tell me that it's there, and I'll go ahead and sell it because it will be oversold at that level. Overbought at that level. The RSI would have peaked a little bit above, kind of waiting for this to happen. I want the RSI, the 10-day RSI, to be right at or above the 200-day moving average. Speaking of the 200-day moving average, and let's now focus on the SPY because the SPY is the main index. Notice how we bounced off that mustard line, the 200-day moving average came back down, and it looks weaker as well. And again, I believe we're going to be coming all the way down here. And one of the reasons I believe that is because if you look at discretionary, looks like it's already way below the 200-day. It looks like we're heading down there, right? Look at the area, right? Looks like we're heading down there. Look at communication services. Really looks like we're heading down there a lot. Look at that trend. Looks like we shook off those. The hedge fund tried to shake us in, right, to get us into a breakout, and then boom, right back down again. So this is not a surprise, and I'm expecting more of these shenanigans to happen. In terms of earnings, and remember, when earnings are in season, and they're really just getting started, they're going to be in season, big in season the next 3 weeks. But we had last night Netflix report. Netflix reported better than expected subscriber growth. Their number was actually not that great, but their subscriber growth was amazing, like amazing subscriber growth. So keep that in mind as we go through this, because subscriber growth is really important to the overall growth of the company. Although I believe that Netflix is way overdone. If you look at the chart of Netflix right here, you will see that it's up about 7% at 337, but look at this. I mean, it's just looking like it's getting into that trend, and it looks like it's just going to come down. I would be very cautious with this company because they're trying to make money on the low end of the scale while their competitors are taking market cap from the upper end of the scale. In other words, they're charging subscribers less money but giving you ads, but other services are taking the competitive edge. So what's happening is the amount of overall people that are going to be subscribing to Netflix is going to eventually be less and less. Ultimately, I see Netflix meeting the same fate as Blockbuster maybe about 5 years from now, unless they get taken over. Now, other earnings that we're seeing today, you've got, let's see here, you've got Ericsson, you've got HBAN, you've got RF, you've got SLB, Schlumberger, and State Street. That's reporting today. We've got Ally Bank. That's a very important earnings because that's a that's like an online internet consumer bank. So if numbers are getting better in that bank, deposits are getting better, it's solid. We'll see how they're doing. Overall, they have not been doing that well. Let me just show you here how they've been doing. What am I doing here? Getting ready to print stuff in the morning? Still too early here. As you can see here, the stock has not been doing well. It has earnings, and I expect it to come right back down. In terms of momentum levels, you've got only, not 313, you only have 76 stocks making 20-day high. Remember, the number was almost, keep your eye on this number as I flip. 115, 313, 473 last Friday, 487 last Thursday, and then I told you when we get to those levels, that usually means we're peaking out. Now, on the 20-day breakdowns, you're starting to get some numbers, 103, and I think that number is going to increase. But still, 100 to the upside, 100 to the downside, very choppy, no directional bias. I wouldn't make anything of it. In terms of sectors, energy, basic materials, financial, and industrial. So let me explain to you why industrial stocks are cooling off. Remember, I told you that industrial stocks, in reality, have two subsectors. They have the defense, the military defense, and then they have traditional industrial stocks that have nothing to do with military. Well, military stocks have been really rallying beginning of the year and causing industrial stocks to go higher. And I warned investors that once those stocks cool off, industrial stocks are going to come back down to materials which were lower because there's just not that much industrial production right now in light of the economy. So the industrial sector was kind of distorted based on what the military stocks were doing, and they were just going crazy. And now they've pulled back, and as a result, it's taking a dump. The industrial stocks have taken a dump, but I don't think that's going to happen very long. And I think as long as basic materials are up here, which is a good sign, I think industrial are going to be in here. But nonetheless, they're still not at the bottom five. They're still the top five. Notice energy, material, financial, industrial, healthcare is coming back. One of the sectors that's being dumped right now is consumer staples, which we are in fact picking up. I think it's a pullback. And if you look at sector performance, which we definitely should, there's a lot more vulnerability right now. But if you look at consumer staples, you've got 18% trading above the 50-day moving average, which is really low, but you still have 36 above the 200, which means there's more meat on the foundation. But let me show you how undervalued these stocks are becoming. Look at that. And this is one of the reasons why I started buying them yesterday. Look at where we're at. We may get a little bit more, but this is going back, 2015? This is 7 years. Look at where we're at. Once we go down to these levels, the odds are we start coming back up. So we may have a little bit more turbulence in consumer staples, but overall, I think we're going to go higher. And I really like consumer staples. I wouldn't put consumer staples in the same category as consumer discretionary or communication services or technology. Not even close. Now let's talk a little bit about what we can expect today from the markets, right? Are you guys loving this? If you guys are loving this report, if you're loving this information, post comments in the YouTube Wealth Press channel, and I'll respond to you. I love responding. I love interacting with you guys, and I love engaging with you. So, new data on the labor market sparked investors' fear that the Federal Reserve would maintain its aggressive path of rate hikes, which is exactly what they've been saying they're going to do. Labor Department showed that unemployment benefits fell to 190,000. That's really, really, really interesting, highlighting labor market resilience that could convince the Fed to continue its aggressive hike. So it's kind of good news, but it's also bad news because the Fed is going to look at that and say, hey, if the labor market can withstand this type of stress, they can withstand more stress. Fed Vice Chair Brainerd said Thursday that inflation is still high and the Fed will keep interest rates elevated for some time. Some time. That's not 2 weeks. Some time to control inflation. Collins supported the case of interest rates to rise to just above 5%. Collins said she favors a more moderate pace of rate hikes. She said more measured rate adjustment in the current phase will better enable us to address the competing risk monetary policy now faces. Basically, they're going to keep doing what they're doing. There's a 97.2% chance of a 0.25 basis point rate hike at the next meeting in February. Now, here's the interesting thing. Earnings. Just 20 days ago, we were expecting a negative 1.6% earnings. We're now 2.8%. Just yesterday, I think we were at 2.6. And I'll give you a full update today in my VIP room. That's happening at 11 a.m. Eastern time. By the way, today's Friday, remember. And today, all eyes are focused on existing home sales. That'll be very, very interesting, but not all that instrumental. That's happening at 10 a.m. Unless the number is just totally, totally out of whack. I'm not expecting anything crazy. Probably, if I had to guess, it's going to be on the low end, but I think most of that is already priced in. If the number's really, really low, like I'm making this up, like 3.5 million, then Wall Street's going to get really nervous. But if the number's anywhere near there, it's not going to be a big deal, especially in light of the fact that existing home sales are now down 35.4% year over year and 7.7% month over month as of December. And typically things slow down in January, February, March. They usually peak around December. People want to start New Year. But then again, it starts again in the summer. In terms of, let me just take you to the stock market. In terms of momentum levels, we are now officially in a bear market. Again, you have 48 or 52 stocks. Basically, half of the market is below the 200-day moving average. And if you look here, you'll see there's a lot more vulnerability. Consumer staples, real estate, communication, utilities, a lot of vulnerability. In the Russell 2000, 43% of stocks are trading above the 200-day moving average. In the NASDAQ, 50%. In the Dow, 40%. Basically, things are back at the 200-day moving average. The rally that we saw is not really all that exciting right now. So looking at the stock market, my theory is, let me just take you here, is that we're going to drop right back down here. We're going to drop right back down to this base, and then we'll see whether we're going to go down further or not. And on the Dow Jones, that would mean we would actually hit the 200-day moving average, which is probably more than likely going to happen. Now, volatility is starting to rise. I warned you it was going to start rising, and I believe it's going to rise further. But keep your eye on the market and also keep your eye on the bond market, because if the bond market doesn't really move a lot, I think stocks will be contained. But we have 3 weeks of back-to-back earnings, S&P earnings, the next 3 weeks. I would find it shocking. I would find it almost impossible if the VIX did not respond by moving higher, especially in light of what we're seeing right now. Now, folks, before I let you go, remember, I'm still a little bearish. I think we need to go down, and I think we're going to start getting a little more choppier. But I think more bearish sentiment is coming to the market. I think the excitement about the Fed stopping early and beginning the deflationary period, I think all that has fizzled out, and we're back into reality land. Keep your eye on Netflix today. It's a big one, a real juicy one, and we'll see how that influences the market. Now, Folks, a major shift is happening in the markets right now. And I'm not talking about just algos. I'm talking about just about everything. We're starting to see option activity driving stock prices. It's really, really cool. It used to be the other way around, but things have changed. Now, very soon, it could be more important to analyze option data than the stock itself. Now, Jack Carter has identified a strategy that can help take advantage of this new change in the markets. It all has to do with trading just one stock a month, just one stock a month. He's going live today at 1:30 p.m., right after I do Ask the Pros at 1 o'clock, and he's going to reveal everything to you. It's going to be really, really great. Click the link below, follow the link, join the event. You guys are going to love, love, love it. Jack Carter is really straight up. He's going to tell you how things are. No monkey business, no banana in the tailpipe, no weird crap. He's going to totally tell you what's going on with the market and how he can help you take advantage of it right now. You don't want to miss out. 1:30 p.m. today. Follow the link below. Check it out now and have a great, great weekend. You can always reach out to me at support@marketgeeks.com and post comments, feedback in the YouTube Wealth Press channel. I want to hear from you. Bye. Have a great weekend, guys. Take care.